Hello, Econ students. This is Mr. Stark. Today we are going to talk about one of my favorite things to talk about in class because it oftentimes gets students' attention. That's personal finance. Some tips, some information that will benefit you almost immediately for many of you, and can benefit you for the rest of your lives. Just some very basic principles. I'm not going to teach you how to get rich, um, but I'll teach you some things to avoid and some general principles that will help you avoid some very big pitfalls um, not too long in the future. So hopefully you read the article and have kind of typed out the notes or filled out the note sheet as you go. We're going to go over those questions in your note guide, and then you're going to take a short personal finance mini quiz after this. So interest rates, most of you probably knew what that is before, but that was basically how much you owe for borrowing money. For example, the interest rate for a mortgage for a house is probably around 4 to 5% right now. For a new credit card, the interest rate is going to be probably 20% or higher. It's definitely a big range. Credit scores. This is one of the things we haven't talked a lot about, but credit score is a big deal. I'm going to show you on a couple slides here in a minute, but credit scores basically is a score that tells people that might lend you money how likely you are to pay them back. So basically it's a score, the higher the better, that shows how trustworthy you've been in the past in paying back debts. And you want a high credit score, as we'll see. That means you'll get a better loan for houses or cars or for college or starting businesses. And low credit scores means you will not get loans for those. You'll have to pay in cash and work to get your credit score up. So definitely you want a high credit score. So challenge questions number one. Well, the most commonly used credit score number, it's an algorithm called the Fair Isaac Corporation or FICO, and the range is 300 to 850. 300 being like just getting started or the worst, 850 being the max. And I'll show you percentages of how many Americans have each category. So Sally and Jane went to get a car loan. Sally's credit score was 550, Jane's was 750. Sally might get a loan, but it's going to have pretty high interest rates because that 550 means she hasn't been very trustworthy in paying back her debts. Jane, on the other hand, has a higher credit score. She has obviously been on time and has been paying back her debts on time. And so she will get a better loan with lower interest rates. Like a 3% for Jane and maybe a 9% for Sally. So, again, credit score. Measure of risk based on the information in a credit report. Credit report basically gives your entire credit history. You can request that at any time. It does not lower your credit score. Requesting your credit score, getting a credit report does not lower your credit score, despite popular myth. Now, your credit score is based on these 5 things. Your payment history is 35%, so how faithful have you been paying back your loans and on time? How much you owe. Even if you've paid back your loans on time, if you owe an extraordinary amount of money, that's going to lower your credit score. Length of credit history. So if you've been borrowing money for several years and have a pretty sound history of paying it back, or did you just get started a year or two ago? That's going to affect your credit score. How much new credit do you have? So if you've been, getting new credit cards and getting new loans and this and that within a year, that's going to lower your credit score. It makes creditors a little nervous when you're getting a lot of different loans in a short period of time. And types of credit. Not all credit's equal. Credit card debt is different from your mortgage, your home debt, as we will see. Now, question I often hear students is, how do I get a credit score? Do I have a low one now or do I not have one? You don't have a credit score right now. You have to be 18 unless you're co-sign on your parents' credit card, and that could potentially get your credit score going, but most of you do not have credit scores, and that's okay. It's better to have no credit score than a bad credit score. So who cares? Why do we need it? Well, pretty much in our culture, which is debt driven, anything from renting an apartment, getting a college loan, getting a car, getting a mortgage, To getting a washer or dryer at Lowe's on a payment plan is going to get your credit score. Employers will oftentimes look at your credit score before hiring you. The rationale is if you have been trustworthy with your finances, you can be trustworthy at the job. Flip side, if you have not been trustworthy, you have a lot of outstanding debts that are late, a lot of creditors are breathing down your neck to get payments in, that doesn't reflect well on what your potential as an employee is going to be. Landlords want to know whether you are going to be paying your monthly rent or not, and utility companies as well. Only 1 out of 3 consumers request their credit scores, and 40% have no idea what their credit score is, which is not good. So credit scores, here they are. Excellent categories in the 750 to 850 range. You will get the best loans. You will have creditors begging to loan you money because they know you're going to be trustworthy paying it back plus the interest. You will have no problem finding a loan. You will get a fixed rate mortgage, meaning that the percent interest rate will not go up with inflation. You'll get a great car loan. If you want to start a business, you'll probably have no problem getting a nice loan from a bank or other investors. Good is 700 to 749. That's 13%. You'll still get a loan in most of those circumstances. Now, maybe you won't get a fixed rate mortgage, or maybe your interest, for your college loans, or maybe if you want to start a business, your interest rates will be higher because it's a little more risk involved. Fair, that's 650 to 699. It's a coin flip. You might get a mortgage, but it'll be a fairly high interest, and it will not be fixed. So you'll have your interest will go up with inflation, which is not a good thing, given that inflation averages 2 to 3% a year. You probably will not get a great loan or get a loan if you're starting a business. Poor and bad, I'm going to lump those together because that's pretty much the same category. You won't get virtually any loans. Like I said, not even a washer or dryer at Lowe's, which you need to finance or make monthly payments on. This is because you have probably not made payments. You've defaulted, meaning you've just not made payments on loans thinking that, oh, what can they do to me? Well, one, they can report it to your credit bureau, which there's 3 different companies that monitor your credit, and they will drop your credit score. Being late on credit card payments, having a lot of different credit cards, foreclosing on a house, unfortunately, really drops your credit card. Your credit score. The number one thing that drops credit score the most, that'll drop it from excellent to bad in a heartbeat, is bankruptcy. If you want a funny version of it, look up office bankruptcy and Michael declares bankruptcy in the middle of the office. That's not how it works. It is not nature's do-over, as Creed told Michael. Bankruptcy is where you go to court and you file bankruptcy, meaning that you are unable to pay back your debtors. There are several types of bankruptcy, but in short, a judge will then look at your assets, things that you own, the money you have, and he or she, the judge, will decide which creditors get paid back with the money that you have. A lot of your debt might get written off. A lot of your debt probably will remain. For example, credit card debt. That's unsecured debt, meaning that the worst they could do is tank your credit score, which is happening. College loans are not forgiven in bankruptcy. You still owe those up until your death. But bankruptcy is actually legal protection. It protects your creditors from taking everything from you. If you have a house, you're probably going to lose the house. You'll have to sell it, downsize. If you've got nice collections or nice jewelry, or you have nice savings accounts, you'll probably need to say goodbye to some of that. But they can't take everything from you if you declare bankruptcy. Typically, you can only declare bankruptcy every 7 to 10 years. And it takes up to 10 years to bring your credit score back up, which means you're going to start down at the bottom at bad, and you've got to pay in cash and find ways to get that credit score up, brick by brick, month after month, year after year, if you want to get loans again. It can be done. There are ways that banks can help you. There are ways that different non-for-profits can help you with that, but it takes time. There is no quick fix from bankruptcy. Now, business bankruptcy is different. Which if you have questions about that, let me know. but I'm talking about personal bankruptcy. All right. So back to personal finance, the notes. Why do you get paid interest for keeping your money in a savings account or a bond? A bond is basically you are loaning money. You are the lender. So if you get a bond through a bank, you are loaning the bank money. And as we talked about with fractional banking, they then lend that money out to people at a higher interest rate. And because you are giving them money in which they will make money on through loaning it to people and interest being paid back to them, you get interest. Now, a savings account is going to get you less than 0.1%. A bonds depends on the type. It can be less than 1%. It can be as much as 3 or 4%. Bonds are not backed up by the FDIC. So if the bank goes under, you will probably lose the bond that you have there. But your savings accounts are secure through the FDIC up to $250,000. Now, I mentioned number 5 that interest rates for unsecured credit's higher. That's because unsecured credit in bankruptcy, it's usually wiped away and forgiven. Therefore, sorry about that. If you heard the screaming in the background, that was my 3-year-old son, Grant, letting us know that his quiet time was almost over. But anyway, so unsecured credit's like a credit card. It's going to be much higher because they're taking a higher risk on you. Because if you can't pay your credit, you just refuse to make payments. Now they can make phone calls. They can, even turn it over to collectors, which are the people that really get nasty and call you at work and threaten you with this or that. But they can't take your money from you, and bankruptcy usually wipes away credit card debt. Now the downside again, that tanks your credit score, and that's going to be very painful to get out of that. Secured credit's a lower interest rate because there's not as much risk. That debt stays with you for pretty much your whole life, such as student loans. It's a much lower interest rate than credit cards because it's much more likely they will get the amount back in full. Now, you watched a video on student loans, hopefully. And that video can scare some students. And I want to start with saying that overwhelming majority of students who take student loans, myself being one of them, has paid back their amounts or paying back their amounts, have no problems. It's not a problem for them. They're not in default. That's the norm. But a growing number of students are finding problems paying back their student loans. And that's kind of why I attached that video, just to show you some of the issues that the young lady was dealing with and some mistakes she made, and she was very forthright with her mistakes that you should avoid. And why do long-term loans carry higher interest rates sometimes? Well, because life happens. That's a greater chance that life's going to happen and you can't pay back the loan, such as you lose your job, a child is sick, you're disabled or get hurt. Those are things that happen in life, and the longer term loan you have, usually the higher interest rate because the more risk they're taking on you. Hopefully that makes sense. So which have a higher interest rate? Challenge questions 2 and 3. Obviously credit cards because they're taking more risk on you. It's unsecured. Which would have a higher interest rate, a 30-year mortgage or a 15-year mortgage? Most Americans, 90%, have 30-year mortgages. You pay less per month, but you end up paying more overall because you're making more interest payments. A 30-year mortgage also will have a higher interest rate because, again, it's a longer loan. There's more time for things to happen in life that will cause you to default or not be able to pay back the loan. A 15-year mortgage, you'll make higher payments, but you pay less overall. But you make higher payments per month, which is why the 30-year mortgage is much more attractive to most Americans. Types of bank accounts. Hopefully you read, and I've mentioned it throughout the semester, you need to save 10% of your income is recommended. Now that's not a hardcore number. You can save more, a little less. The average American saves around 1% or less. Again, you need to be saving it up for a rainy day fund. That's something that unfortunately in our day and age right now, a lot of Americans, 26 million have been in the last 8 weeks have been unemployed. A lot of them unfortunately didn't have, savings to get them through. And so they're really having difficult times right now. And, you know, there is those unemployment benefits, which we talked about in Standard 4. But with 26 million Americans, the system's backlogged and it takes more time to get your unemployment checks. And this reading suggests you keep 3 to 6 months of living expenses saved up. That's because it could take you 3 to 6 months to find a new job or for whatever crisis is happening to lift. That is a significant amount. So, you know, if think about Starkonomics, if you can remember what your monthly expenses were, you know, if your monthly expenses were, you know, $2,000 a month, that means you need to have anywhere from $6,000 to $12,000 saved up. So if you lose your job, you can pay your living expenses with just your savings. All right, we'll come back to different types of bank accounts here in just a moment. But you've heard of CDs, certificates of deposit. These are things, they're popular for, like, you know, my grandparents had certificate of deposits for me when I was born. Basically, it's money that they invest in the bank, they loan to the bank. It's a long-term bond, kind of like that. And then when that CD has matured, or basically if it's a 10-year CD, and at 10 years it's matured, you can pull that money out plus whatever interest rate you got as well. Now, you can reinvest that if you want in the bank and then get more interest on it if you don't need it. But at the same time, you can pull the CD out before if you really need the cash, but you're going to pay a penalty. You're going to get a chunk of it that you're not going to get back because it wasn't quite mature yet. And you can get them all the way from 1 month all the way down to, you know, 10 plus years. And as you can see, interest rates are better than a savings account. Not great. Again, not really going to keep up with inflation. You're going to need bonds or the stock market to do that, but it's better than a savings account. So if you have money that you know you don't need for years, instead of a savings account, 0.1% or less, you can put it in a CD. You have what's called money market accounts. These are savings accounts, kind of souped up savings accounts. These are ones that will pay higher interest rates, but they also require you to start with more money in them. Some money markets require you to start with 1,000. Ones that have higher percentages require you to, you know, have 10,000 or even 25,000 or even $100,000 to start with. And of course, they pay higher interest rates. Typically, you know, maybe 0.2% or even 0.3. The good news with money market accounts is the interest rates also go up with inflation. It's not going to keep you above inflation, but the interest rates at least go up with inflation. So, types of accounts. It gives you kind of the checking account, of course, is one that you pull money out all the time. Savings account, as you read, safe interest rate a little bit, but you also have limited withdrawals typically. Same thing with money markets. Typically, there's limited withdrawals. CDs, you can't withdraw it until, you know, it's mature. If you do, you're going to lose money. So first one right here requires you that you leave your money in the account untouched for a certain period of time. That's the CD. Limited transfers and withdrawals. That's a money market account, and I'd also say a savings account too. Oftentimes, you know, 6 a month, and you can withdraw it directly out of your account with a debit card. That's checking. Now, let's be very clear here. Well, I'll get to that in a second, but checking accounts are not credit cards. They don't help your credit score by paying. It's not a loan. A checking account is just simply money that's in your account that you're taking it out directly. A couple questions. Bobby is planning to going on a trip to Europe in 2 years. He has 8,000 saved up. Bobby wants to keep 5,000 available as account for emergencies. He knows that he will not touch the remaining 3,000 until he goes to Europe. So where should he put his 3,000 if he's not going to touch it? 2 years, if he can wait? Well, hopefully you're thinking a CD. Again, it's going to have higher interest rates, it's safe, and at the end he collects it back with interest, which could be, you know, hundreds of dollars potentially. 10. Emily is a college student who only has 2,000 saved up. Because she doesn't have a job, she frequently needs to withdraw money to pay for living expenses. car maintenance and emergencies. However, she doesn't want to keep her money just in her checking account because the interest rate's so low. Some checking accounts have interest rates, most of them don't. What type of account should she keep her money in? Well, not a CD because she needs it, the money frequently. Not a checking account, so that leaves a money market or a savings account. Probably a savings account because again it will allow you to withdraw more per month, whereas a money market account they're only going to limit you to like maybe half a dozen a month. So most likely a savings account. Types of credit cards, we're about done. So we got credit card, debit card, and prepaid card. So which charge you interest if you don't pay the balance off each month? Well, that is a credit card. Credit card is a loan. Basically, you're getting a monthly loan. If you pay back that full amount every month, you don't owe any interest at all, which is huge. So again, if you pay back your credit card every single month in full, what you spend on it, you will not owe any interest. If you don't, the money that you still owe, interest is going to be, again, starting at probably 20% or higher, and it will then compound from there, which is how people get into serious credit card trouble. Because that 20% interest rate each month compounds and gets bigger and bigger and bigger. People typically just make minimum payments on it, and I'll show you a credit card statement in a minute. But a credit card is a loan. You owe that money back each month. If you don't pay it, you owe interest on it. However, getting a credit card and paying it off, paying money on it, will raise your credit score. So students often ask, how can I get a credit score to start with? One of the things that I recommend, if you know yourself and you can control your spending when you go to college, get one credit card and spend maybe $50 a month on it. If you're disciplined, pay that $50 off every single month, and then by the end of your college, 4 years, 12 months, that's 48 on-time full payments you've made. You'll have a pretty good credit score getting out of college, and there are other ways as well. If you have questions about that, let me know. Send me an email. Can be reloadable or disposable. Those are prepaid cards like Visa gift cards, things like that. Build credit history to enable renting an apartment, obtaining loans, or getting car insurance. That is a credit card, as I just said. Incurs overdraft fees if you spend more than the amount of money. That's a debit card, the dreaded overdraft fees. So if you have $100 in your debit account and you swipe it for 150, well, it goes through magically, but the bank has just forked over an extra $50. They're going to charge you that $50 plus an overdraft fee, which could be anywhere from 20 to 50 to excess of that. And every time you do it from that point on, you're going to owe that overdraft fee. And the bank really won't even necessarily notify you of that until you have several overdraft fees already incurred. So one of the best things you can do if you have a debit card is tie it into your savings account electronically, which means that first of all, you can get cell phone alerts. So if you're within so much money of having no money in your debit, let's say you're within $50, you'll get an alert on your phone saying you only have $50 left on your debit card, just to remind you. And then you can tie it in with your savings. So let's say that same scenario, you have a $100 charge, you swipe the debit for $150, it empties out your debit account, but then takes $50 out of your savings, but you avoid the overdraft fee. So that's just a little idea for you. Incurs over the limit fee if you spend more than your loan limit. That's credit card. When you get a credit card, there's a limit you can spend per year. You can't buy everything and all you want with a credit card. Typically, with your first credit card, it's a lower limit, maybe a couple $1,000s, all the way up to those famous black credit cards you see on movies that have a $100,000 limit or more. So if you charge more than that a year, then you will get extra fees on it. Next one, purchases draw money from your checking account. That is obviously a debit card, can offer reward points. Normally a credit card, you can get like Visa Miles, or you can get free gas cards or just cash back. Some debit cards offer that also. And this is the last slide, credit card statement. This is an example of one you might see. So for example, this gives you your payment summary. This is the most important box. Okay, this is the amount you owe, or else you're going to owe interest. This is the minimum payment. This is not going to do much for you. It'll keep them from calling you and being on your back. But as you can see, you're still going to owe a lot after that, plus the interest rate. All right, which most credit card statements give the interest rate. This one doesn't, but it's going to be probably 20% or more. And it gives you the due date. Now, if you pay this off in full, you owe no interest. It used to be they would make this minimum payment in bold on front of the credit card statement so people would think, oh, this is all I owe, and they pay the minimum payment, and then the fun begins. Let me make this 100% clear. Credit card companies or businesses, they make money off of people who don't pay the full amount back and then owe interest. They make no money off people who pay it off every month. It is in their interest to get people to pay interest on their credit card. They want that. But if you pay the full amount every month, you will owe no interest. But legally now they have to put the total amount in front of the minimum payment because it was deemed by the courts as being suspect. This gives you your limit. So this card has $20,000. There's still $17,000 that you can still spend on it. This gives you the points if you get credit card or if you get cash back or airline miles or so on and so forth. So anyway, hopefully that gives you a little bit of an example of what your credit card statement looks like. Now you're going to take the personal finance notes, and the next class you're going to watch kind of a fun, it was a special that came out in the last recession in 2009 where a bunch of celebrities put together like skits teaching financial responsibilities. That'll be what you do next class. Until then, do the personal finance quiz and send me questions. I'll talk to you later. Oh, I'm sorry. Number 11, I almost forgot about this. Ms. Fry thinks you should use a credit card as if it were a debit card. Why do you think that is? Well, if you are good at paying back your amount, you can collect points on it and you can get like cash back. So actually, if you pay back your credit card every month and then you get cash back every couple months, they're actually paying you to use their credit card. And if it's bad if you have poor self-control, well, I call it the Amazon syndrome. If you just cannot be on Amazon without spending money, delay getting a credit card, period. All right, that's it.